Hello, everyone. Grayson here from SES Services doing a weekly market update. We like to find some topics from the financial headlines and go a little bit further into depth. Today, we'd like to talk about our Federal Reserve sending a loan over to Switzerland last week. Okay, so volatility still reigning supreme in the financial markets right now. We had a pretty crazy week last week. Core CPI numbers came out on Thursday. They were still 8.2% September over September. But there was still a gain September over August, which, for market watchers, that's a serious concern. The Federal Reserve has been aggressively raising interest rates to combat inflation. And the idea was that the near-term inflation was going to start coming in, because there's something like 19 months over the 2% target that the Federal Reserve tells us that they have for inflation. So 19 months in a row over that target. Hey, sooner or later, this should start coming in, right? Crude oil, 115 a couple of months ago, all the way back down into the mid 80s. That should help. Employment numbers, we've got more first-time unemployment filings. The wage growth is slowing. So all these things, you would think that the inflation numbers would start coming in, and to this point, they're really not. So Thursday, the market started way in the hole after those numbers came out, surprising to the upside. Hey, inflation is still bad, meaning the Fed is going to have to keep raising rates. So that means stock and bond prices need to be lower. So the market started so much lower, but the short covering, so many financial speculators are short selling bonds and stocks, and the short covering started in the bonds last Thursday morning, and it spilled over to the stocks. By the end of the day, S&P 500 had rocketed higher to, I believe it was the fifth largest intraday reversal ever. So some people thinking, well, maybe that's the low of this. We're only 8 or 10 months into a bear market. Maybe that's the low, and maybe it is. But Friday, some numbers came out, and more thought of the Fed having to loan money over to Switzerland came out, and the market gave most of Thursday back on Friday. Looks like we're doing better on a short covering rally again today, which is Monday, but we'll see. So again, I wanted to talk about Switzerland because, for years we've been saying central banks around the world can't just print money forever. There's an end game to that. We've been saying for at least 6 or 8 years that, by our estimation, the canary in the coal mine was probably the Japanese yen. To this point, we have not been proven correct because some things that are starting to break. The first one was a few months ago over in Britain. The Bank of England had to come out and backstop, meaning support the pricing of their government bonds, because so many pension funds were really looking in trouble if the valuation of these bonds continued lower. It would turn into some sort of a Lehman Brothers moment from 2008 that the Bank of England wanted to avoid. So they backstopped it. Now they're saying there's a time limit on their backstopping of the bonds. So maybe they're going all the way back to QE. Maybe they're not. Maybe they're going to continue to try to raise interest rates and then just support whatever breakage happens in their financial markets. Nobody knows how that really is going to roll out. But the one thing that, and again, with Switzerland, and most people didn't notice it, but on October 5th, the Federal Reserve, our central bank, did a short-term loan over to Switzerland of over $3 billion. They did another one last week, so they're over $6 billion, which is huge, maybe an all-time record on these short-term swaps that they're giving the Swiss bank. And of course, that begs the question, well, what's going on in Switzerland? Switzerland's supposed to be one of the best economies on the planet by a margin. Credit Suisse is the likely candidate. And a little bit of a scary part from that perspective is the size and the complexity of Credit Suisse. If there's really something going south there, it's going to be hard to figure out how, when, why, where, how bad it gets, because Credit Suisse is enormous. Credit Suisse dwarfs Lehman Brothers. So if something bad does happen, if something bad is happening, nobody really knows how that could roll out, how that could domino, how that could spiral into worse situations. So really, we continue to see the Federal Reserve talking about raising rates, and clearly raising rates, lower inflation is not a perfect correlation at all. And some of the quick inflation may actually be caused by the Fed raising rates. We know that the conditions for all this inflation were because of the Federal Reserve just pouring too much money on the game, for sure. How do you tame it now? That's clearly, the world history has shown that's more of an art form than a science. So we have to pay attention. We have to do our best to find cracks in the dam, so to speak. And it's really, when the Fed is continually raising interest rates, lots and lots of people overseas are getting squeezed because they have dollar denominated debt. And take a look at a chart of the US dollar. If you're a foreign economy, and let me move the screen here so you can see the top of the dollar chart. This is an index of the US dollar. Over here is 2003 all the way up to today. So you're seeing quite a lot of strength. And again, so much debt after 2008 and even after 2018, so much debt worldwide is denominated in US dollars, but whoever's paying the bill, whoever's paying the debt service, they're doing that with their own local currency, with their own local economy. And all the problems we've got all around the globe, well, that can get to be a big issue. Some people are not going to be able to finance their debts. Again, this kind of thing goes on. You're not really sure when and where it's going to happen. Bank of England was a surprise. To this point, it hasn't happened in Japan, but their monetary system could be in some big trouble. And really, the catalyst to this going forward could very well be the US dollar getting stronger. As an American investor, there's some silver lining to things going bad, because it's the strength of your currency and the strength of your savings that's making it happen. That can really spiral into a whole bunch of other problems that we really don't want to see. So we have to sit back and watch. Hey, is this a short covering rally? Lots and lots of foreigners are still short the dollar. The US dollar is the grease, so to speak, the oil of the mechanisms of the world economy. And when there aren't as many dollars going in there, the wheels get squeaky and we start to have some problems. So continued strength in the US dollar could turn into the catalyst, the straw that broke, whatever analogy you want to use. And the Federal Reserve continuing to aggressively raise interest rates could turn into a problem. Could see some other things breaking around the world. But again, theoretically, last week could have been the low in the stock market, and consequently, maybe some of the world stock markets. We'll see going forward. We're always trying to pay attention, like I said, to cracks that are coming in the dam. Feel free. Hey, if you like our weekly market update, please click that you like it below. Click subscribe. Forward this video to other people. Forward the content on to others. We're always here. Be happy to sit down with you for a no obligation consultation. Our information is there. We have clients all around the country, so we actually do Zoom consultations as well. No obligation and no cost to you. So hope you enjoy the content. Keep your portfolio tight and lighten up if you have too much risk and you're not sleeping well at night. Keep some cash for sure, and don't sell your gold. Keep everything together, and hope to see you next week. Thanks.